I see this every single week. Real estate investors and business owners who think the LLC itself is the protection. It's not. The LLC is the shell. What you do is the protection. And most people are doing it wrong in ways that don't show up until they get sued. And then it's too late to fix. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no taxes using my zero tax blueprint. Here are 5 mistakes that are setting you up to lose everything the LLC was supposed to protect. Mistake number 1, commingling funds. If you're running personal expenses through your business account or business expenses through your personal account, stop right now. This is the single fastest way to hand a plaintiff's attorney the argument they need to pierce your veil. Alter ego isn't a technicality, it's the whole case. If a judge can look at your books and not tell where the LLC ends and you begin, they'll rule that it never really existed as a separate entity in the first place. That means your personal assets, your home, your savings, your other properties are back on the table. One business, one bank account, one credit card, every time. If you're paying yourself, it's your documented distribution or a payroll run, not a debit swipe at Target for groceries. Mistake number 2, ignoring formalities. No operating agreement, no documented decisions, no minutes when a multi-member deal changes hands. Here's what people don't get. The operating agreement isn't paperwork for paperwork's sake. It's the first document opposing counsel requests when they're trying to prove your LLC is a sham. If it doesn't exist, or it exists but nobody follows it, you've told the court this entity is a formality, not a real business. Same goes for annual meetings, resolutions for major decisions, and keeping your registered agent and state filings current. None of this is complicated. It just has to actually happen on paper, consistently, not reconstructed after you've already been served. Mistake number 3, wrong entity selection for the goal. This is where I see the most money left on the table. Defaulting to disregarded or partnership taxation when an S-Corp election would cut your self-employment tax, electing an S-Corp too early before there's enough profit to justify running payroll, or, and this one's expensive, electing S-Corp on an LLC holding real estate, which torches your basis step up and blows up your 1031 and Section 121 exclusion planning. The entity election is a tax strategy decision made on purpose based on what that specific entity does, not a default setting you accept because that's what the formation service picked for you. Get this wrong, and it's not just a misdeduction, it's a structural mistake that follows the entity for the life of the asset. Mistake number 4, multi-state registration gaps. If you own a short-term rental in another state, or you're managing property remotely across state lines and you haven't either registered your current LLC as a foreign LLC in that state, or filed a domestic LLC in that state, you have a problem you don't know about yet. Most people find out the hard way. Back fees, penalties, and the state saying your LLC doesn't even have standing to sue in their courts. Think about that for a second. You could be the one who gets stiffed by a contractor or a tenant, and you legally can't bring the case because your entity was never authorized to do business there. You can be fully compliant in your home state and still be completely exposed everywhere else you operate. Mistake number 5, mixing high-risk and low-risk assets. One LLC, multiple properties, or a rental sitting in the same activity as an active business. This is the mistake that turns a single lawsuit into a total loss. The entire point of separate entities is isolating risk, so when something goes wrong with one asset, it can't reach into the others. A tenant slips and falls at property A, and if your property B, C, and D are sitting in that same LLC, they're all exposed to satisfy that judgment. If everything's in one basket, you don't have asset protection. You have the illusion of it. And a false sense of security is worse than knowing you're exposed, because at least then you'd fix it. None of this is complicated. It's just not what most people were told when they formed their LLC off a $200 online service. The LLC is the vehicle. The strategy, the bank accounts, the formalities, the tax election, the registrations, the separation of risk, that's what actually protects you. Don't assume this is covered. Bookkeeping and tax prep don't automatically include entity compliance. And unless you have a specific agreement with someone that says otherwise, it's on you. If you're in business, that's just part of the job. Know the rules your entity has to follow, not just the ones on your tax return. If any of those 5 mistakes gave you pause, That's your sign to check now, while it's just a checklist, not a lawsuit. Please share this video if you found it helpful and subscribe to the channel. I'll see you next time.